We're live now. Very excited about my guest today, Nikhil. Thank you so much for joining us. You are famously the man that is calling for a price target of $150,000 for ETH. If you don't mind introducing yourself, just a little bit about your background, how you got into this space, and then we can jump right into questions.
Yeah, sure. I just graduated medical school, so my background's not really in investing at all. Actually, I was in medical school, and I'm going into internal medicine residency in the next month or two. And then, as far as kind of investing, I've been interested in investing in markets since high school. Got into crypto very late, honestly, last year with kind of the Bitcoin halving event, and
Yeah,
went down the rabbit hole. So I'm excited to be here.
nice, awesome. So, yeah, I'm curious. Obviously, this isn't what you do full time. How did you find the time to write this massive paper? I mean, was it just a COVID thing? You were bored, you had extra time, you wanted to get this out there. I mean, it sounds like you just did it kind of as a hobby, right?
Yeah, it was mostly as a hobby, never intended to write the paper. I just like that, what was in the paper was the case that I had been building for myself for why I was going to go basically all in on ETH back. And I've been, all in for the last year now. And so I just, when you own that much of an asset, I mean, for me, it's not that, I guess it's not much money relative to what other people own, but as a medical student who's never had a full-time job, it
Yeah.
was a big amount. And so when you're all in, you spend a lot of time reading about it, thinking about it. You don't just make that decision lightly. And so I had the thesis kind of in my mind, but I kind of assumed that most people were on the same page. And so then when Justin Drake tweeted about, I think he was using an analogy to show that the sell pressure reduction of EIP 1559, and he was
Mhm.
analogizing that to the size of Grayscale and the deposit contract. And so I was kind of thinking that's not really a good way to conceptualize it. But obviously Justin Drake is a genius, and he was way ahead of me on this for sure. And so I just put a little tweet kind of analogizing to the triple halving, because that was how I had thought about it.
Yeah.
And when it caught on, I realized a lot of people are not thinking about it the same way I am. Even if we have the same information, I think I'm putting it together differently. And so there might be something worth doing here. And so I just, honestly, the paper itself took 5-7 days, but the ideas obviously had been percolating for a while.
Yeah, absolutely. Just before I get into it, you just highlighted you're pretty much all in on ETH. In your Twitter bio, you say you're irresponsibly long ETH. Obviously, you're under no obligation to share with us your position, but from a percentage standpoint, when you say all in, does that mean this is the main asset you're holding on top of just cash and whatnot?
Yeah, I think it's 95% or nine. It's
Okay.
above 90%. I've been fiddling with some stuff with DeFi, but yeah, it's definitely higher than 90%. And I just want to pause and say none of this is investment advice.
Of course,
I
yeah.
am nowhere near any level of financial advisory status. Cannot give investment advice. Also, just seen a lot of irresponsible advice being given. So the amount that I have, it's 90% sounds like a lot, but contextualize that. I'm 26 years old and I have about to start my first full-time job. So the total cost basis is a small fraction of next year's annual salary for me. You know what I
Yeah.
mean? So it's big picture. If this thing goes to zero, I will survive. And that's why I'm so heavily allocated, because I think there's asymmetry, right? So
Gotcha.
if you're out there and you're betting your future on this, just please do not do that. But
No,
yeah,
that's
so I'm
great
very
advice. I
heavily
appreciate
allocated.
that. Just before we get into the hard questions, I guess, can you give for folks that haven't read it? And again, I recommend everyone should read the full paper. If not, at least read the one-page summary, because I mean everyone has time to read a page. But for those that haven't read it, can you give a quick TLDR on kind of your base case, what that is, why 50,000, and then just a few bullet points on the case for that.
Yeah, so the TLDR is that there's two big events, EIP 1559 and the merged proof
Hmm.
of stake. They're both happening within the next 6 months, and they're going to cause the amount of Ethereum being sold on the market every day to reduce. And so when there is less supply and the same amount or higher demand, price should go up. And so I kind of look at a bunch of different reasons for why there'll be even less supply than that. And I kind of talk about how the potential for demand is higher now than it was before because there are easier access routes to buying crypto, more funds are involved in the space, things like that. And then I kind of look at some valuation models because when the price starts rising, the best way to kind of think about where it could go is to have some approach to valuing. And so the valuations that I came up with all were kind of a base case of 30 to 50,000. And I was looking at it and I was thinking there's definitely going to be supply shock here. And if it goes to 50,000, you're going to be in full on mania. So, things don't tend to just hit their fair value and stop.
Yeah.
So I would expect it to kind of spike above that and then probably crash after that. And so I talk about how, buyer beware, but I think it could go to 150,000 in the mania. And I would be surprised if it could hold that price. It'll likely only kind of have a speculative peak there.
Gotcha. So one of the things that I found most interesting about what you wrote, you were actually the first person that introduced me to this theory of why you can't price in like supply halvings. And like I'm a traditional finance person, efficient market person. Can you just briefly talk about why your rationale for why you don't think this can be priced in?
Yeah, so certain aspects of it can, and certain aspects of it can't. So like when I talk about how ETH is going to scale, and that's going to make it better able to compete with traditional finance. You can price that in because you can just say, okay, that's going to make it worth more, and I'll buy ahead of that news and price it in. But I talk about some more structural flows that can't be priced in because they basically the price is a reflection of who is buying and selling, and so if when you price something in, what you are saying is that information that will make people buy it in the future, like I know that information, so I'm going to act on it now, move the price, and once it hits that higher price, no one's going to buy it in the future, and so you move like future money flows to the present, and that kind of prices the information in. So instead of waiting for Tesla's new product to come out for the price to go up, you say, well, like this product's going to make the price, it's going to make it worth a lot more. I'll buy it now. You move, instead of future buyers getting it, you move that to me buying it right now. Price goes up. And then those future buyers, they don't keep buying because now they look at it and they're like, well, the price reflects that information. But if there's some structural reason that they have to keep buying, then you can't, then that means the information cannot be priced in. So I talk about in my paper for Tesla how before and after it was added to the S&P 500, it moved up, and I talk about how, like, in my view, I mean, it's very hard to prove these things out, but like in my view, what you have is Tesla's moving up beforehand because everyone's saying, "Wow, it's added to the S&P 500. That's a huge new source of buyers," but an S&P 500 tracking ETF can't just go out and buy Tesla until it's been added. And so after it's been added, you still have to buy. And so that information can't be priced in. That information can only be priced in after the event has actually taken place. So yeah, that's like a kind of non-arbitrageable or like non-price sinnable flow. And I think the sell pressure dynamics that we're going to see with EIP 1559 and proof of stake are the same way, where it's not like the day of these events the price is going to spike up, but in the like months afterwards, there's just going to be a concrete amount that's of like reduced selling every day that you don't have before. And so no matter what the price is doing beforehand, this effect will add on top of that. And so, yeah, it's actually interesting too, because I mean, like with the Tesla example, we're seeing the same thing with Ethereum, where it's like, or we were until the most recent sell-off, where the price is very capable of like of skyrocketing before the catalysts, but they don't affect my catalysts. So like I think it's at 2,700 right now, but if it crashes, then it crashes. But if it were to rise back to where it was, that's can't price that like doesn't reduce the effect of these catalysts at all. They just layer on top of that. And that's kind of the effect that I'm going for. Is that's why these prices can get so aggressive, because unlike a normal like stock, when the price goes up, it doesn't prevent these kind of future flows from coming in.
Gotcha. No, that's great. Thank you for explaining that. I do have a ton of questions prepared, but to everyone watching, if you do have questions, put them in the chat. We will get to them and select some to answer. My first kind of follow up to that is, how do you think the price of Bitcoin affects this? Right, like if Bitcoin crashed to say 10,000 or 5,000, whatever price, or just stayed stagnant for the next year, a few months, whatever. Obviously, ETH is very correlated. Are you expecting ETH to decouple from BTC?
Yeah, I mean, it's going to stay correlated for a while. I think that it'll decouple quite a bit after, like in more 2022, I think. Just because, I mean, it could decouple the end of 2021, but these catalysts are going to be why. So right now, it's going to be very correlated just because people who are, there's like, I see it as like three kind of primary things going on. It's like funds going into crypto are mostly buying Bitcoin, maybe diversifying into a little Ethereum. And then that kind of ratio has been shifting in Ethereum's direction a little bit lately. Then the second thing would be people who are literally just selling their Bitcoin to buy Ethereum, which has been going on more lately. And the third thing would be people who are getting funds out of crypto entirely, I guess. And so I think it's still this like Bitcoin centric. It's still this huge like Bitcoin centric buying and selling of Ethereum, and I think that that dynamic has to change. And the way that it changes is mostly by these catalysts happening, where like before they happen, it's mostly speculative, and I mean in the narrative. But after they happen, I think the media can pick up on this, and people talk about proof of stake. The yields will be very attractive. If a $300 billion asset has a like 15% yield, that makes a big splash, right? That's like something that people will talk about. So yeah, then I think that's a world where they start to decouple.
Yeah, on that note, I think I saw an interview with you where you were basically talking about like there's going to be this proof of stake return on ETH. It doesn't really matter what the price of ETH is because different investors and institutions can find a way to hedge the risk on ETH and still get that 15% or some percentage yield. Can you just talk more about that? I thought that was such an interesting point.
Yeah. So it's a really cool kind of situation because the staking yield on ETH is denominated in ETH. And the other thing is it's coming from issuance rather than like a fixed coupon or something. So the cool thing about that is it's a lot less risky than a cash flow from a company because it's not like, oh, if like something happens, then you won't get the issuance yield. You'll get the issuance yield. The risk is going to come from somewhere else, which is if more people stake, then the issuance to like the yield to each of the stakers goes down. But the nice thing about that is if more people stake, there's less liquid supply of ETH. So that kind of creates a supply squeeze. And then kind of to go back to what you're saying, I looked at it and I was like, there's going to be a ton of incentive to stake your Ethereum because it's not just about like absolute yields. There are ways to kind of capture that. And so if the yield on Ether is 15%, let's say, it's 15% whether ETH is at $500 or $50,000 because it's denominated in ETH. And so if you own 100 ETH, you get 15 ETH no matter what the price of ETH is. The cool thing about that is that you could hedge that out. So you could buy 100 ETH, stake it, short 100 ETH futures, and like whatever that issuance is you just get you can like kind of capture that issuance. And I mean, that's a really like crude mechanism of doing it. I think there's going to be a lot of like more sophisticated yield products that, I mean, it's DeFi. We're going to create financial products for it.
Yeah.
So it's like, you're not going to need to go through all that to do it, I think. But the point is like, there's no like yields aren't going to stop going down because like 7% is like a good discount rate or something. As long as you can keep capturing that yield, people are going to keep staking and capturing that free money. And so that's great. It's a good reason institutions will come in, and it's also a good reason why much more ETH will be staked than people expect, which is really bullish. So
Yeah. So I see this question from Samir here about Arbitrum, which for those watching that aren't familiar, essentially it's a true layer 2 solution for Ethereum that was just launched a few days ago. My question is kind of similar to what Samir is asking, just running off of that. So obviously ETH becomes deflationary with EIP 1559. But with layer 2, there actually has to be like more transaction volume happening on layer 2 to account for the lost gas on layer 1. Obviously, like I'm biased. I work in DeFi. I have this channel. I believe strongly in DeFi, and it sounds like you do too. But isn't there an inherent risk there? Like if everything stayed stagnant and all of this traffic just went to L2, and we didn't see like huge inflows on the Ethereum network itself, like what does that mean for your hypothesis here?
yeah, I mean, if yeah, if the number of people who use DeFi like was completely unaffected by the fact that it's a lot cheaper to use DeFi,
Yeah,
I mean, yeah, then ETH would be less valuable. I just think like it's almost like definitionally not true. It's like if it's even cheaper to use a service and it's a valuable service today, then I just don't see how it wouldn't become a more valuable service.
yeah,
Yeah, tomorrow. I mean, there's like interesting dynamics there with competition, but I think the key. So layer two solutions, they just decongest the network. So they're like if you have, I don't know, if you have 100 transactions that can kind of go on at any given time on the network, and you can take like all 100 transactions off and move them to a layer two, where they're either off chain or they're somehow kind of elsewhere, and you can net them together, and then you can just have one transaction on the layer one. Then you've turned 100 transactions into one transaction, and your risk is the like robustness of the layer two. So you want nothing to go wrong with the 100 transactions it's holding. And then you also have the risk with the layer one you're using. So if you're settling it then at the end with one transaction on the Ethereum network, then you need Ethereum to be secure. And so every layer two is only as secure at best, it's as secure as the layer one that it's on. And at worst, the layer two itself could have other security issues, right? And so I think a couple of things. One is Ethereum being like the most secure network today, but also after proof of stake, it'll just be the most secure blockchain out there in existence. And so that means that layer twos on it will be a lot more secure than anywhere else. But the other thing that's interesting is like right now, gas fees are determined by like I am doing a transaction on layer one, and I'm not willing to pay more than like $20 for gas, and so I'll just sit and wait. I'll be like, okay, when the gas fees like low enough. But eventually none of us are going to be transacting on layer one, because why would I pay $20 when I can pay like 9 cents on layer two? And the flip side, though, is that means that the layer twos, when they settle, you can kind of view them as customers with bigger wallets, right? And so if I don't know, if Arbitrum is settling on the layer one, and a Visa has a layer two of their own, and they're also settling all of their transactions on layer one, you could see the gas fees actually going like way higher on layer one, which wouldn't affect like me, because I'm going to be transacting on a layer two. But again, it comes back to just like there's the world that you painted is one where demand doesn't move at all. And so in that case, because you're decongesting the network, Ethereum would become much less valuable. But you can imagine a world where, because you're decongesting the network, the only players who are playing are players with huge wallets, and Ethereum block space becomes like the most valuable commodity, and the gas fees could skyrocket as a result. So it'll be interesting to see how it all plays out. But I see layer twos as like incredibly good as for people who hold Ether, like pretty unambiguously good. Yeah.
Gotcha. Just a quick follow up on that. It sounds like you're probably in a similar realm as me, where you think like Ethereum will become the default chain for DeFi, etc. But like, just curious, like, do you think ETH will own the market there? What do you think of other competitors, other chains?
Yeah, I mean, short term, well, okay, let's just like do time horizons here, right? Like the next 5 years, I'm not even like, I don't even need to really, I could just like go to sleep for 3 years and I'd be really comfortable that Ethereum like has the market, just because, I mean, as comfortable as you can get. There's always black swans, and this is really like emerging space and things happen. But like Ethereum has such a big lead, and not just in terms of developers and products and like an ecosystem, but also just like a lot of people look at relative security, but at some scale, absolute security starts to matter. So when you look at the kinds of adoption that people are putting forth for Ethereum right now, where you have like an investment bank listing bonds on the Ethereum network, that's fantastic. And that, like, you know, and maybe some investment bank could come and list bonds on Solana, and that's totally plausible. But the key question is like, how does that work at scale? Like, can like huge chunks of the bond market move on to Solana? And I'd argue that'd be difficult because, well, I can tell you this much: the value of the bonds can't exceed the market cap of Solana, right? Like if you list bonds that are worth like 100 billion, and the market, I don't even know what the market cap of Solana is, but if the market cap were less than that, then you'd have a real problem on your hands, because the security of Solana would not be higher than the value secured by the network. So what that means is, from a security perspective, Ethereum has a huge like absolute advantage, which is that if I'm even close to right, then it's going to be a multi-trillion-dollar asset. And with proof of stake, that means in order to attack the security of it, you would need like $1 trillion. The benefit of that is it can house, now it can like really, like if you're trying to tokenize real estate, like you can do that in Ethereum at scale in a way that you cannot do on smaller chains. So in the short term, again, like 3 to 5 years, like Ethereum just rules because of that, because you just can do things on it that you can't, for purely practical considerations, you can't do elsewhere if Ethereum can scale. That's obviously a huge caveat. And then long term, I mean, no one can know. That's just like not how competitive dynamics work. You know, if like other L1s come out that are really like intelligent, creative solutions to things, I mean, it's always possible that people find out a way to achieve even higher levels of security with even better scaling elsewhere. And if they do, then I'm sure long-term things will move wherever the best design is. But that's just where we are right now.
Gotcha. So we have a question here from the community basically asking, what would be the total crypto market cap in your estimation, if you've even thought of that, when ETH hits if ETH hits your price target? And just some reference here for everyone watching, at your price target of 150,000 ETH, I think that's a 16 trillion or so market cap. So just some reference there for anyone that's not familiar.
Yeah. So yeah, exactly. So I don't know what the total crypto market cap would be. I mean, I don't know. I guess like it'd be 16 trillion plus. I see. The thing is, it really just basically depends where Bitcoin is, because everything else will be smaller fractions. So it really just depends on where Bitcoin would be. But yeah, I mean, I don't know, maybe like 30 trillion or something like that. It would be a ton of money. But again, that would be market cap, but very small fraction of that would be liquid, which means that like it does not have to stay there for long. It could collapse, and it could collapse a lot. I mean, that's the crazy thing. I was thinking about this yesterday because I was like thinking about how to monetize the position. I was like, man, if it goes to 150K, then I was like, man, if it goes to $150,000, then it could drop 66% and still be at $50,000. You know what I mean?
Yeah.
And that means like, that's why what I'm trying to get at when I'm saying like, this doesn't have to be sustained for very long. Like it could go to 150K, it could collapse by 90% and still be at 15K, which is a lot of people's target for this cycle, you know, and that'd be down 90% from the peak. And that would be the bear market, you know, and everyone would be like, oh God, like the worst things that happened. And I'd be sitting there like, what? Like we're still at 15K. That's so high. After 90% drawdown. So yeah, I mean, that's why the market cap number honestly is really misleading, because I just think it's very realistic that the market cap will just be absolutely silly. But that's not a good way of measuring how much realized wealth will accrue. Like if a lot of people who have like 1,000 Ether wallets at 150,000, they'll all be like 150 millionaires, right? But that's kind of the thing, is like, as soon as any of them start meaningfully cashing out, we're gonna like crash hard.
Yeah.
So yeah, that's kind of how to
Yeah,
think
no,
about it.
I wanted to actually touch on this. I'm just thinking out loud here, but it's something you've brought up now, and I'm thinking about like, is market cap even a like? It's helpful because we want to know what's the value of the network, and it's fun to talk about. But is it even a helpful metric for these type of assets? Like with Ethereum, if Ethereum, kind of dominated like the global financial settlement layer, there's no central company behind it. There's no problem with the monopoly. No one's issuing new shares themselves. Obviously, ETH has issuance, but like, does it even matter? Is that like a relevant metric of the market cap? What do you think about that?
Yeah, no, I do think it matters. I think what matters is what market cap can be sustained, though. The reason it matters is because you have to think about where the money is coming from. So there's like two ways. I think. I mean, this is potentially a little bit outside of my expertise, but I would say just there's two ways that I think about it. One is that you can increase the market cap of one asset by reducing the market cap of another because people who own stocks start selling them to buy crypto, right? Another way is that you actually expand GDP, which means like the like advent of the internet, like the GDP, a significant percentage of the GDP growth, I would assume is attributable to the fact that the internet created new jobs, created new opportunities, made things more efficient. So market caps that seemed silly like could become realized because if like 1% of GDP growth comes just straight from the internet, then that's just like 1% of GDP now accrues to the market caps of these internet companies and they go ballistic, right? But the reason that's important is because that's why I talk about how like when I say ETH 150K, like I don't think that's sustainable because like in order for it to be sustainable, you would need, it's what people criticize my argument for. It's like you need $15 trillion to like move and not be needed elsewhere. And the thing is like, who has that money? Like, where's that money coming from that it's just going to be happy to sit in crypto? And what you would need is all the new millionaires would have to like cash out as much as they want and have new buyers come in at that price. But at 15 trillion, those new buyers actually have to come up with $15 trillion. Like the newly minted millionaires didn't. Like my cost basis is very small compared to what my position is worth now. Same. So that's the thing. In order to sustain the valuation, you need new buyers to have like deep pockets. And so that means like, if I think 30 to 50 is like a fair value now, it's like any growth company, like Ethereum and all of crypto, it has to grow into its valuation a little bit. And it hasn't we haven't like hit that reality yet. But like, if it's 30 to 50K, like the way we sustain 150K is by like making finance more efficient, so that more money accrues to like consumers. And then that like unlocks the trillions of dollars in the economy, I don't think a viable route to 150K is to have like trillions of dollars of equities just sold so that people can buy crypto. That's not sustainable. Like it just doesn't make sense to me. But I think that's kind of the promise of crypto. And that's a longer term promise that it will, if it is revolutionary, it will change the world. And what that concretely has to mean is GDP growth and things like that. So,
yeah. Similar note here, like macroeconomic scale. I'm not sure if you've thought about it at all, but like obviously the big news right now in the crypto community is inflation and why crypto's a hedge against that. Me personally, like I've kind of pushed back on that a little. I've shared resources in the community about why Bitcoin doesn't actually act as an inflation hedge or hasn't historically. And then like a lot of people like Michael Saylor and other influencers in this space are calling for like, they're saying we really have 20% annualized inflation now or something like that. Like, what do you think about inflation in the economy? What does that mean for crypto? Is that something you factored in at all?
Yeah. I mean, so I feel like speaking to like actual just inflation, whether it's happening, how much it's happening, I just don't have an expertise there. So I just don't want to kind of speak too much on that because it's like, that's the purview of like economists and pension fund managers and
not medical students,
not medical students. And so, yeah, it's like looking at like the CPI and like what that means is just not something that I feel informed about. But I agree with you. I can at least speculate that like, I don't think that Bitcoin's an inflation hedge, or at least I think you can't just use price as a evidence of inflation hedge unless if you do, then every stock while it's going up is a great inflation hedge. and while it's going down is terrible. It's like just like concretely, when Bitcoin's going down, it's the worst inflation hedge of all time. And when
Yeah.
it's going up, it's going up more than every other asset. So I guess by definition, it's a better inflation hedge than every other asset. But all that says is that like the asset that goes up the most protects you the most from inflation, which I think is really trivial to say. What you really want when you say something's an inflation hedge is you want to say that like when inflation happens, it causes the price of the asset to go up. And that you can't just show that by showing the price went up, because you get spurious correlations where it's like,
Yeah.
The temperature goes up in the summer and like the Bitcoin's price also goes up in the summer. And so like those are, related. No, those are not related. And so you can't just do that. You have to show it's caused. One causes the other. And if you want to argue, like a lot of people do, that Bitcoin is still in price discovery mode, then the primary cause of Bitcoin's price is not inflation. It is price discovery of a new asset. Because like even if you take like people's most aggressive estimates of inflation, which I think it shows up like in healthcare the most, or like tuition costs the most, like that just does not account for Bitcoin's price rise. Bitcoin is rising. If it's up 600% this year or something, like healthcare costs are not up 600% over the same time period. And so Bitcoin is like dramatically over hedging inflation, if you want to take that, And so if that's the case, then, 570% of the price move is price discovery not related to inflation, which means, it's just terrible. Like it means you're making much more of a bet on price discovery related to something outside of inflation than you are now. Whether it could become a good inflation hedge in the future is, remains to be seen. But honestly, like most of the really intelligent approaches to hedging inflation that I've seen tend to look directly at the things that are being inflated. So like if you're worried that you won't be able to buy water because of inflation, like you buy the water utility. Or like if you're worried about like your ability to build a house, like you have an allocation to lumber, so that when the prices of lumber go up, you like have hedged literally directly against that. And so it's the same way where like research on gold shows that it's like not been a great inflation hedge. It like retains its purchasing power, but there are better inflation hedges in terms of things that are literally just correlated with inflation over time. So just be careful. I think it's like be careful for like to carefully define what you're looking for. Like when you say inflation hedge, like what do you mean? And then depending on what you're looking for, like how has gold performed? What would it look like if Bitcoin were performing, and how would you like falsify that? And that's kind of how I'm thinking about it.
No, that's great. Just on a similar note, really quickly, if you don't mind sharing your thoughts on Bitcoin, I guess if you said you had 95% of your portfolio in Ethereum, who knows? Like, I assume it's not a priority. Like, Bitcoin is not an asset you're optimizing for, but would just love to hear your quick thoughts there.
Yeah, I mean, Bitcoin's interesting. It's like a known quantity. So, like for me, I think that if you're getting into a disruptive technology with an insanely high, addressable market, like why would I want the known quantity? But I kind of see where people are coming from. It's a known quantity in an unknown world, where the unknown world is like fiat debasement and the Fed and this macro narrative, right? And so that's potentially attractive. I think like the main reason I'm not allocated to Bitcoin at all is just because I just think like the total addressable market of Ethereum is much, much larger and potentially encompasses Bitcoin's market. Just because if Ethereum's store of value narrative kind of holds out, it could like cannibalize Bitcoin while also growing elsewhere. So I just feel like owning both of them in my portfolio, like I would hate for my Bitcoin exposure just go down and my Ethereum to go up like by stealing from Bitcoin. That would just be like self-destructive. And so, I think I see it. So one interesting thing is that even if Ethereum is an extremely effective store of value, which I believe it will be, it stores value by burning fees, and fees will be something that will change over time. And so the fee burn is going to change over time, even the issuance, because the amount staked will change. And so the degree of deflation we get will change. And there might even be spots on the way where, because of new scaling solutions or whatever, where we're not instantly and always deflationary every single day. And so that means if you want something that's like more consistently storing value, like maybe you still want that kind of just fixed, simple supply of Bitcoin. Um, I think that the like two things I would need to look more deeply into the whole Bitcoin climate change stuff. I don't want to take a stance on it yet. I think there are some really good points being made by Bitcoin proponents about how maybe it creates an economic incentive for renewables, but it's just something where like this could also just be confirmation bias. So I just want to be really skeptical and careful because I'm very climate conscious. And then the other question I have is security, because I think Ethereum is just going to be in a class of its own on security, and I really would I think it matters. It matters a ton when as the block reward goes down, where is the incentive to secure the network going to come from long term? And I mean, maybe like I just need to do the math more and kind of figure out like if the incentive's high enough. But like if Ethereum is right now, I think Justin Drake said it was like a $5 billion hash rate. Sorry, for Bitcoin. I think it's like $5 billion to secure the Bitcoin network, and the market cap's like around $1 trillion. But so if market cap's like 10 trillion, even if the hash rate grows, like I think a lot of people might be willing to pay 10 billion to get 10 trillion, and so it's like a lot of people, quote unquote. But I think like you have to realize like $10 billion is within the purview of like a lot of major corporations. You'd hope they don't have any like, random reason to be malicious, but like it's not as much as it would seem. Whereas if Ethereum has a $10 trillion market cap, it would literally take like multiple trillions of dollars to attack the network. And no one has that. Like no one can afford, and you'd have to burn. And the other thing is like the way that you attack the network involves potentially getting your Ethereum slashed. Whereas Bitcoin, you can just keep attacking, or you could like sell the hardware, or you can kind of do things. So yeah, it just like the security issue is a big question mark for me.
Yeah, no, it's interesting. I when the crypto flash crash happened, I put out a video and I was just basically talking about the climate narrative that presumably dropped the price of Bitcoin. Who knows, of course. But my case was basically just like, even if all of this energy is renewable that's getting spent to or used to secure the network, it doesn't really matter, because that renewable resource could have been better spent elsewhere by like the opponents of Bitcoins from their perspective. So I think just like the fact that it uses so much energy is something that anyone can argue against, whether it comes from renewables or not. And to me, I mean, I'm not a security expert, just like as a fair warning, but it just seems like the Ethereum model of moving to proof of stake just makes more sense for so many different reasons. In any case, moving on, it looks like we have a question from Up Down Choice. They ask, what does the price of ETH need to be on the day of 1559 for your 150K thesis to hold, if it matters?
Yeah, that's a good question. I'm not sure what it would need to be on the day of 1559, because so most of my thesis is that, I mean, honestly, so first of all, if there's 3 halvings in my reports, triple halving, I'd say like 0.5 of that is EIP 1559 and 2.5 of that is proof of stake. So that's basically to say, like, in other words, if it's a triple halving, almost all of that is the merged proof of stake. EIP 1559 is like a miniature halving event. But the other really important thing is it creates this deflationary monetary policy, which is like a great way to move money into the asset. The way my thesis works is you have these catalysts that kick off price, and then once price starts to get going, it's less about the catalyst and more about the narrative. And the narrative will be based on these valuation models that I show take you to 30 to 50K and higher. So it's like, it's interesting because it's not as dependent on where the price is before the catalysts. But obviously, if the price was like 200 before the catalysts, that would make things much more difficult. So, hopefully we don't crash 90% between now and then. But yeah, I don't have a hard number on it. I think there's a lot of different paths that are possible to get to that end valuation.
Gotcha. Now, you actually specifically say you're kind of going to avoid this in your report when you basically say, like, I'm just going to look at the technical aspects of what these halvings will do to the price based on the supply or the lower amount of issuance on the supply. You mentioned you were in DeFi bit. Can you talk a bit about like where you see the future of DeFi? Is it something you're very bullish on? Some of your favorite protocols or projects, etc.?
Yeah. So definitely really bullish on DeFi. Honestly, so full transparency, I got into the space really recently, right? And
Yeah,
so I was mostly concentrated on Ethereum, and I wrote the report trying to be agnostic towards the space because I felt that I had a lot of unanswered questions about the long-term value of DeFi, but I still felt very certain that a very high conviction that I would make a lot of money just holding Ethereum because of these kind of flows based arguments I make.
yeah,
So it's very noticeable that I'm not making any like fundamentals of DeFi arguments in my report. And the reason at the time was just because I didn't know enough, and I still don't know enough. But I've looked into it a lot more. It's been a really nice thing about just publishing and getting a lot of conversations going in the space.
yeah,
So yeah, I'm really bullish on DeFi more broadly. I think right now I have like I haven't written this up at all, but I have like very small positions. But I have a position in Chainlink and Thor Chain. Basically, like the reason I haven't written it up yet is because they're pretty like speculative starter
sure,
positions. But the thesis is that like the Oracle market is going to just be another very large market. And I think what I saw in Chainlink was two things. What I saw, one was the place where security matters a lot, because for the same reason that we worry about layer ones being hacked, you might worry about like the Oracle being hacked, where if like
yeah,
I have a smart contract that pays out based on the winner of the football game, and I source that from ESPN, and I also source that from like seven other APIs. It's gonna like matter a ton that the smart contract not lie about what the API is saying. And so you need the maximum possible security for your oracles. And so yeah, so I think that's a potential moat in the space, because it's not, I mean, Chainlink has a lot of really cool things where it's like integrated into a million different applications that makes me interested. And then the fact that the link token is incorporated as well in the use of the service, so I can see kind of how value might accrue. And then the final thing was that I could see like a differentiated advantage where, kind of like Ethereum, I think potentially there's this winner take all, at least in the beginning, approach where if I list a product that needs an oracle, like I am not willing to touch a speculative, like if you don't list Chainlink as the oracle you're using, I think we'll see a world where people will just not be able to trust your
yeah,
product. And so it just made me interested. And then the other one, I think, so I looked at Thorchain, and yeah, chain interoperability is really interesting. Again, I just don't know enough, so I haven't written it up yet, but it's like, I'm looking into it and I'm like, oh, liquidity pools, the size of the liquidity pool could be a moat here, where if you have multiple providers of this kind of a swap, but like Thorchain just has like more liquidity in it, then you might seize a lot more of the volume because you have less slippage there and stuff like that. And it's another interesting like uncorrelated potentially bet. I mean, it's correlated empirically on price, but it's like fundamentals uncorrelated, because if like Solana runs loose and gets crazy and does really well, it doesn't really hurt my like Thorchain or Chainlink thesis at all, if I have one. So that's what makes me interested. And I'm always looking for like, how are the token used in the service, because I want to know how value accrues. And then I want to know like just normal competition things, like why is this going to survive the best minds in the world trying to make a better service. And so those are the two things I'm kind of looking at. And then the other thing is just like broadly, I think I'm really looking forward to, I think like scaling solutions are the thing that's holding back retail adoption of the space. So I talked about this earlier, where it's like, in order to achieve like the valuations that people are talking about, like we are in a bubble until we unlock some real value. Then we can grow into our valuations and it won't be a bubble, right? So like the way that happens is scaling solutions come out, credit card transactions move on to DeFi for a third of the cost, and that remaining 2/3 is like unlocked to the consumer and the store owner and things like that. And I think that that's all going to start really happening 2022 and forward. So it's kind of interesting. We could see, and honestly, this people were saying this about the last bear market, which I was not part of crypto for, but it's like we could see some of the most dramatic growth of the space in a bear market if all these catalysts come through and we have a speculative peak. And then, if we see price crashing from there, it'll be funny because price will be crashing, but like with proof of stake in the past and scaling solutions kind of developed, we'll actually see like the most organic adoption in that environment. I don't know. It's funny how that happens, but yeah, overall pretty bullish.
No, that's great. Yeah. Just a heads up to everyone, I do want to be respectful of Nikhil's time. So if you have questions, just put them in the chat now. We'll probably start to wind down. We have a question from Filippo Fannin. Out of curiosity, where do you stake your ETH right now, if at all? Just as a side note, in the DeFi innovation community, which is an incredible Discord community I run, and link below, I've like said, like, just because we love DeFi here doesn't mean we can't like enjoy the security of staking on Coinbase and have that fixed percentage. Just because you're so new to DeFi, I assume you probably have a similar ethos if that's where you're staking, but I'd be curious if you use something else like Lido or a different protocol.
Yeah, I think right now I have like a little bit staking through Coinbase and a little bit unstaked. It's because I need a plan. I need to be more thoughtful about things. It's just like I'm still trying to figure out what the best approach is in terms of like what I want to do at the peak or at higher levels. And so if I want to just buy and hold for the next 5-10 years, then I should just be staking everything. But if I'm like, no, like I'm going to monetize a little bit or something like that, then I don't want to have that staked away. And so I just need a better plan. But I staked a little bit on it through Coinbase just because I was like, look, I'm definitely not going to sell all of it short term. So yeah. And then longer term, I think it'd be really fun to like learn how to stake my own like validator node. That'd be super cool. I'm gonna have to pool with a bunch of people, obviously, to get the ETH, but still, it'd be fun. So yeah, I don't know. I'm looking at. I think Rocket Pool's coming out with a cool solution, and there's other ones.
Awesome. Yeah. No, that's interesting. Cool. So yeah, I mean, I just want to thank you so much for your time. Unless anyone has any last minute questions, I did see Updown Choice just had a clarifying question if there's a hard cap on July with 1559. Just to clarify on this, like the issuance will only become net negative if transaction volume hits a certain amount. So there will still be inflationary pressure until the network grows to a scale where there's deflationary pressure at like about 1 or 2% decrease a year, which I think is where we're at now, just based on something Justin Drake put out.
Yep. Yeah, exactly. So yeah, it'll like if we see EIP 1559 come out and fees are where they are right now, then we'll see deflation. If fees drop, then we might temporarily see inflation until fees rise back up. And then we'd expect to see like this long-term deflation, which is great. The other thing that's interesting is thinking about total supply versus circulating supply. So it's like 85% of Bitcoin has already been mined and is circulating. And so they have a net like static monetary supply where there's no change in total BTC. But that's kind of like saying that the supply of gold is net static because there's no change in the amount of like gold in the universe or something. In reality, gold stock to flow is useful because gold is mined and Bitcoin is mined as well. The unique thing about Bitcoin is that the like stock to flow is so high because the amount that you mine is getting smaller and smaller. So the interesting thing there is when you look at circulating supply, the circulating supply of Bitcoin actually is just constantly expanding, and the degree to which it expands is slowing, but it's still expanding. And for Ethereum, the circulating supply has been constantly expanding, but the circulating supply has been equal to the total supply. That flips on its head completely in the next year or two because two things. One is that EIP 1559 means circulating supply actually decreases, which is the opposite of what's happening for Bitcoin. The second thing is if Bitcoin mining like is pulling Bitcoin out of it's like out of the ground almost. Ethereum staking is doing the opposite. It's like we're putting Ethereum back into the ground. It's locking up that supply. And so literally like everything about the supply demand dynamics is going to shift in Ethereum's favor because of these two things. We're literally like moving Ethereum out of circulating supply, where Bitcoin is like continuing to add it, and we're doing that in through fee burn, but we're also doing that in like a total supply way, where they're actually like there's going to be staked ether that's just not going to come back, which is really cool. Yeah.
No, that's great. Thank you so much. Jason has a great question that will help wind us down. What would you like to write about next? Just going to do a little plug for you here. I know you have a newsletter that you've been working on. I will pin a comment below and put it in the description to link to that. And then I'll also link your Twitter. I think that's there now. But most people will probably be watching this after the live stream. So please give Nikhil a follow. I'm sure you're receptive to comments on Twitter and whatnot. And other than that, if you're new to the channel, please subscribe. Check out the DeFi Innovation Community, which is a Discord community below. It's free. We all help ourselves in DeFi and learn about new projects. Other than that, thank you so much. Do you have any closing comments?
Definitely check out my Substack for what I'm going to write about next. I'll definitely write on there. I think like little things I'm going to try to cover some like, on the way up. I'm trying to cover some like options approaches to DeFi, like little weird curiosities that I'm looking at because the option space in DeFi has been really strange. I'm also definitely looking into just writing up like DeFi. I think I'm going to probably try to hold back on publishing more frequently and just try to like let its thoughts simmer and mature for longer. So it might take a while, but look to my Substack. I'm sure I'll email and tweet about it at squishchaos and then squishchaos.substack.com.
Yep, please. And all of those links are going to be below if you're watching this when it's not live. So thank you so much. Best of luck in the medical field. I hope we stay in touch. I hope your price target comes true, of course. And thank you for everything you do. All right, everyone.